Introduction Money Shackles, The Breakout Guide to Alternative Investing, by Dutch Mendenhall. 1. A personal backstory. Dutch Mendenhall opens by introducing himself not just as an author, but as someone who personally lived through financial struggle and uncertainty before discovering a better way. He shares that although he came from a family with investor parents, his early life was full of financial instability, feast or famine, and setbacks. A serious injury dashed his dream of becoming a professional athlete, leaving him to face life's financial challenges firsthand. 2. The American Dream Revisited. Mendenhall explains that the traditional American dream, with its focus on steady jobs, Wall Street investing, retirement accounts, and conventional financial advice has become outdated or even a trap for many people. He suggests that most people remain stuck in financial routines that create stress, vulnerability, and dependency rather than true financial freedom. 3. Introducing Money Shackles. The book's title, Money Shackles, refers metaphorically to the financial constraints and mental patterns that keep most people from achieving real wealth and long-term security. Instead of just offering more traditional tips, Mendenhall proposes a rethinking of investing and wealth building, focusing on alternative investments that go beyond stocks and bonds and provide greater stability, diversification, and control. 4. The promise of alternative investing. In the introduction, the author previews the book's main goal: to help readers break free from financial vulnerability by understanding and using alternative investment strategies from real estate and fractional ownership to tools that hedge against inflation and systemic risk. According to the promotional material, the book also covers frameworks such as freedom principles and freedom traps, which help identify and avoid common financial mistakes. 5. Who this book is for. Mendenhall stresses that Money Shackles isn't a get-rich-quick manual. Instead, it's written for serious investors, both beginners and experienced, who are ready to rethink how they grow, protect, and preserve wealth. He frames the content as actionable, jargon-free guidance designed to help readers build financial peace of mind, long-term security, and legacy wealth. 6. A call to action. The introduction concludes with a call to action. Readers are in the right moment to seize opportunities in alternative investments, which Mendenhall portrays as an emerging trend with massive growth potential and a chance to redefine personal financial success beyond the limitations of traditional systems. In summary, the introduction prepares the reader to challenge traditional financial beliefs, understand the shortcomings of conventional investing, discover alternative strategies that can lead to greater financial freedom, approach wealth with confidence and informed action. Overall theme: wealth and freedom are not just about earning more, they're about investing differently and breaking free from the financial shackles that hold most people back. Chapter 1. The Reality of Financial Vulnerability. This opening chapter is a wake-up call. Dutch Mendenhall's main goal is to help readers see the financial system clearly, without optimism or fear, just reality. Most people believe they're financially safe, but in truth, they're financially vulnerable. 1. What financial vulnerability really means. Mendenhall defines financial vulnerability as depending on one income source, relying on traditional investments, 401ks, stocks, pensions, having little control over money decisions, being exposed to risks you don't understand. Many people feel secure because they have a job, they save regularly, they invest in retirement accounts. But security is not the same as control. 2. The illusion of safety. The chapter explains how the system appears safe but isn't. Examples of false security. A stable job can disappear overnight. A pension depends on institutions staying solvent. A 401 tied to market volatility and inflation. What feels stable today can become fragile tomorrow. 3. Inflation, the silent threat. One of the biggest vulnerabilities is inflation. Mendenhall emphasizes, inflation quietly erodes purchasing power. Money sitting in savings loses value every year. Traditional advice often ignores this reality. Even when markets go up, Your real wealth may be going down. Losing money slowly feels safer, but it's still losing. 4. Dependency is the real risk. The chapter stresses that dependence equals vulnerability. Dependence on employers. Dependence on Wall Street. Dependence on government systems. When your future relies on systems you don't control, you are exposed even if things look fine today. 5. Why most people don't see the risk. Mendenhall explains that people stay vulnerable because the system rewards obedience, not awareness. Financial education is minimal. Questioning traditional advice is discouraged. People are taught, just work hard, save, and trust the system. But no one asks, what if the system changes? What if inflation spikes? What if markets crash near retirement? 6. Vulnerability is not a personal failure. A key point in this chapter. Financial vulnerability is systemic, not personal. You're not bad with money. You weren't given better options. This realization removes shame and opens the door to empowerment. 7. Awareness is the first breakout step. Mendenhall emphasizes, you can't fix what you don't see. Awareness precedes freedom. This chapter is about seeing reality clearly, not panic. Awareness is not fear, it's power. 8. Practical application, what you can do now. Step 1. Assess your exposure. Ask yourself, how many income sources do I have? How much control do I have over my investments? How exposed am I to inflation? Step 2. Question traditional advice. Don't blindly accept. Stocks always go up. 401x are enough. Cash is safe. Step 3. Prepare to learn alternatives. This chapter sets the stage for alternative investing, real assets, diversification beyond Wall Street. 9. Key takeaways from Chapter 1. Insight meaning. Financial vulnerability is widespread, even among successful people. Traditional security is fragile, jobs and markets change. Inflation is a hidden enemy. It erodes wealth silently. Dependence creates risk. Control creates resilience. Awareness is empowerment, the first step to freedom. In one sentence, financial vulnerability isn't about how much money you make. It's about how exposed and dependent your financial life really is. Chapter 2. Redefining Your American Dream. This chapter challenges one of the deepest financial beliefs most people carry without ever questioning it. The traditional American dream no longer guarantees security, freedom, or peace. Mendenhall's goal here is not to attack hard work, but to expose outdated assumptions about success and wealth.
1. The old American dream. The traditional version looks like this. Get good grades, get a stable job, buy a house, invest in a 401k, retire someday. This model worked decades ago when pensions were reliable, inflation was low, job loyalty was rewarded, living costs were manageable. But the environment has changed. The advice hasn't. 2. Why the dream is broken. Mendenhall explains that today, wages haven't kept up with inflation, job security is fragile, retirement ages keep increasing, healthcare and housing costs explode. As a result, people work harder but feel poorer. Saving feels pointless. Retirement feels uncertain. The dream didn't fail because people stopped working hard. It failed because the system changed. 3. Comfort versus freedom. A powerful distinction in this chapter. Comfort equals predictable routine, false security. Freedom equals control, flexibility, options. Most people are chasing comfort, stable paycheck, familiar systems, predictable routines, but comfort often comes at the cost of long-term freedom. 4. Redefining the American dream. Mendenhall proposes a new definition: freedom, not retirement, control, not dependence, assets, not just income. The new dream focuses on cash flow instead of just salary, ownership instead of reliance, resilience instead of optimism. 5. Ownership is the new security. This chapter emphasizes owning assets gives leverage. Assets work whether you show up or not. Ownership protects against inflation and disruption. This includes real estate, businesses, alternative investments. Income feeds you, assets free you. 6. Time is the true currency. Mendenhall reframes success, not how much you earn, but how much control you have over your time. A high income with no time freedom is still a trap. The new American dream values flexibility, choice, autonomy. 7. Why redefining the dream is uncomfortable. The chapter acknowledges questioning the dream feels risky. Most people follow what's familiar. Change feels unsafe. But staying in an outdated model is more dangerous than adapting. 8. Practical application. How to apply this chapter. Step 1. Audit your dream. Ask yourself, who taught me my definition of success? Is it still valid today? Does it lead to freedom or dependence? Step 2. Shift your goal. Replace retire someday with build freedom now. Step 3. Think like an owner. Begin learning how assets generate income, alternative investments work. Money can work independently of your labor. 9. Key takeaways from Chapter 2. Insight. The old dream is outdated, meaning the system has changed. Hard work alone isn't enough, meaning strategy matters. Comfort not equaling freedom, meaning familiarity can trap you. Ownership creates security, meaning assets outperform income. Time is the real wealth, meaning money should buy freedom. In one sentence, the American dream must be redefined from working for money to owning assets that create freedom, control, and resilience. Chapter 3. Assessing your money personality. This chapter shifts from systems to self-awareness. Mendenhall explains that how you think about money directly affects how you earn, invest, and protect it. Your financial results are often a reflection of your money personality, not your income. 1. What is a money personality? A money personality is your emotional relationship with money, how you react to risk, loss, and opportunity, the habits you repeat unconsciously. It's shaped by upbringing, early financial experiences, cultural beliefs, past wins or failures. Most people never examine it, and it silently controls decisions. 2. Why money personality matters. Mendenhall explains that how you think about money directly affects how you earn, invest, and protect it. Your financial results are often a reflection of your money personality, not your income. 3. Common money personalities. While not rigid labels, Mendenhall highlights common patterns. 1. The saver. Avoids risk, prioritizes safety, keeps money in cash or low-yield accounts. Strength, discipline. Risk, inflation erosion, missed opportunity. 2. The spender. Enjoys immediate rewards, lives in the present, struggles with delayed gratification. Strength, optimism, confidence. Risk, lack of long-term security. 3. The traditionalist. Trusts conventional advice. Follows safe paths like 401k, pensions. Avoids questioning the system. Strength, consistency. Risk, blind dependence. 4. The risk avoider. Fear-driven decisions. Avoids investing altogether. Focuses on what could go wrong. Strength, caution. Risk, paralysis and stagnation. 5. The wealth builder. Seeks understanding. Focuses on assets and cash flow. Thinks long-term and strategically. Strength, adaptability. Risk requires education and patience. 4. Emotional triggers around money. Mendenhall emphasizes fear leads to inaction, greed leads to poor decisions, impatience leads to losses. Understanding emotional triggers prevents impulsive investing, improves long-term outcomes. Wealth is built emotionally before it's built financially. 5. Money habits reveal your personality. Pay attention to how you react during market drops, whether you avoid looking at finances, how you feel spending or investing. These reactions expose hidden beliefs. 6. Self-awareness creates control. Once you recognize your personality, you stop self-sabotage. You choose strategies aligned with you. You invest intentionally, not emotionally. There is no best personality, only unexamined ones. 7. Practical application. How to apply this chapter. Step 1. Identify your dominant pattern. Ask, do I fear losing more than I value growth? Do I chase comfort or freedom? Do I avoid money decisions? Step 2. Match strategy to personality. Risk-averse, focus on real assets and cash flow. Spenders, automate investing. Traditionalists, diversify beyond Wall Street. Step 3. Evolve intentionally. Your money personality is not fixed. Awareness allows growth. 8. Key takeaways from Chapter 3. Insight. Meaning. Money behavior is emotional, not just logical. Awareness beats income. Mindset drives outcomes. No personality is wrong. Unexamined ones are risky. Strategy must match personality, or it fails. Self-awareness creates freedom. Control replaces fear. In one sentence, understanding your money personality is the first step to making intentional financial decisions instead of emotional ones. Chapter 4. Reframing Debt and Borrowing. This chapter challenges one of the most emotionally charged beliefs about money. Not all debt is bad, but misunderstanding debt is dangerous. Mendenhall reframes debt from something to fear into a tool that can either trap you or free you, depending on how it's used. 1. Why most people fear debt. Most people are taught debt is irresponsible, borrowing is dangerous, being debt-free equals safety. While this advice protects against reckless spending, it also discourages leverage, limits growth, keeps people dependent on income. Fear-based rules create financial stagnation. 2. The difference between consumer debt and strategic debt. Mendenhall draws a clear distinction. Consumer or bad debt, credit cards, high-interest personal loans, debt used for consumption. Result, drains cash flow and increases vulnerability. Strategic or productive debt, used to acquire income-producing assets, backed by cash flow, structured with favorable terms. Result, increases leverage, growth, and control. 3. Why the wealthy use debt differently. The wealthy use debt to control assets, let cash flow service the debt, benefit from tax advantages. Debt becomes a tool, not a burden, leverage, not stress. Debt doesn't create risk, misuse of debt does. 4. Inflation makes strategic debt powerful. Mendenhall explains, inflation reduces the real cost of fixed-rate debt. Assets often rise with inflation, debt stays constant while asset value grows. This creates wealth acceleration, protection against currency devaluation. 5. Why avoiding all debt keeps you trapped. Avoiding all debt often means saving slowly, missing opportunity, staying dependent on income. Mendenhall stresses, playing defense only doesn't win the game. 6. Borrowing without understanding is dangerous. The chapter also warns, debt without education is risky, leverage magnifies mistakes, emotional borrowing leads to failure. Debt requires strategy, cash flow analysis, risk awareness. 7. Practical application. How to apply this chapter. Step 1. Audit your current debt. Ask, is this debt producing income? Does it improve or harm cash flow? Is the interest fixed or variable? Step 2. Eliminate harmful debt. Target, high-interest consumer debt, emotionally driven borrowing. Step 3. Learn strategic borrowing. Before borrowing, understand the asset, understand the cash flow, understand the exit strategy. 8. Key takeaways from Chapter 4. Insight. Debt is a tool, not inherently bad. Consumer debt destroys wealth. Strategic debt builds it. Inflation favors borrowers with fixed-rate debt. Wealthy use leverage, not fear. Education makes debt safe. Ignorance makes it dangerous. In one sentence, debt isn't the enemy. Uneducated borrowing is. Chapter 5. Getting Started with Alternative Investing. This chapter marks a turning point in the book. After exposing the weaknesses of traditional finance, Mendenhall now introduces the solution, alternative investing. Alternative investing is how you move from dependence to control. 1. What is alternative investing? Mendenhall defines alternative investing as investments outside traditional stocks and bonds, assets with intrinsic value, opportunities that provide cash flow, stability, and diversification. Examples include real estate, private equity, businesses, hard assets, and fractional ownership opportunities. Alternative investments focus on ownership, not speculation. 2. Why traditional investing falls short. The chapter explains key limitations of Wall Street investing: little control over outcomes, exposure to volatility, dependence on market timing, long lockup periods, retirement accounts. Most investors are price takers, emotionally reactive, disconnected from the assets they own. 3. Control is the core advantage. Mendenhall emphasizes alternative investments offer decision-making power. You understand what you own. Performance isn't purely market-driven. Control includes choosing assets, managing risk, influencing cash flow. Control reduces vulnerability. 4. Cash flow versus appreciation. A major mindset shift in this chapter. Traditional investing focus on appreciation, future value. Alternative investing focus on cash flow, present income. Cash flow supports lifestyle, reduces stress, allows reinvestment, creates flexibility. Cash flow buys freedom before retirement. 5. Risk is reduced through understanding. Mendenhall reframes risk. Risk is not volatility. Risk is not understanding what you own. Alternative investing reduces risk by transparency, tangible assets, predictable income streams. 6. Barriers to entry are mostly mental. The chapter addresses common fears. This is only for the wealthy. I don't know enough. It sounds complicated. Mendenhall clarifies, access has expanded. Education removes fear. Small steps build confidence. 7. Start small, think long-term. He encourages learning before leaping, starting with manageable investments, building experience gradually. You don't need to go big, you need to go smart. Practical application. How to apply this chapter. Step 1. Shift your mindset. Stop asking, how much can I make? Start asking, how much control do I have? Does this produce cash flow? Step 2. Learn the categories. Begin exploring real estate, private businesses, alternative funds. Step 3. Focus on education first. Understand how the asset works. Learn how money flows. Know the risks and exits. 9. Key takeaways from Chapter 5. Insight. Meaning. Alternative investing equals ownership, not speculation. Control reduces risk. Understanding matters. Cash flow is foundational, not appreciation. Traditional markets limit flexibility. Alternatives expand options. Access is increasing. Education is key. In one sentence, alternative investing shifts you from hoping markets work in your favor to owning assets that create control, cash flow, and resilience. Chapter 6: Choosing Fractional Ownership. This chapter removes one of the biggest mental barriers to investing. You don't need to be wealthy to own real assets. Mendenhall introduces fractional ownership as a way for everyday investors to access opportunities that were once reserved for institutions and the ultra-wealthy. 1. What is fractional ownership? Fractional ownership means owning a portion of a larger asset, sharing ownership with other investors, participating in income and growth proportionally. Instead of buying an entire asset alone, you own a piece of it. Examples: real estate syndications, private equity funds, income-producing businesses. 2. Why fractional ownership matters. Mendenhall explains that fractional ownership lowers the cost of entry, spreads risk, provides access to higher quality assets. It's better to own a fraction of a strong asset than 100% of a weak one. 3. Breaking the all-or-nothing myth. Many people believe, if I can't buy it outright, I shouldn't invest. Ownership means total control. Mendenhall reframes this. Partial ownership still creates cash flow. Diversification matters more than control. Leverage through collaboration reduces risk. 4. Access to professional management. A major advantage highlighted: assets are often managed by experienced operators. Investors benefit from expertise. Time commitment is reduced. This allows passive income, scalability, and reduced emotional decision-making. 5. Diversification through fractional ownership. Instead of putting all capital into one property or asset, you can spread investments across multiple assets, reduce exposure to single-point failure. Diversification increases resilience, not just returns. 6. Risks still exist. Awareness is key. Mendenhall is clear. Fractional ownership is not risk-free. Success depends on quality of the asset, integrity of the operator, and alignment of incentives. Education remains essential. 7. Fractional ownership versus traditional investing. Traditional investing: public markets, private assets, little control, greater transparency, high volatility, asset-backed stability, speculative, income-focused. 8. Practical application. How to apply this chapter. Step 1. Drop the "I need more money" belief. Start with education, access, and understanding. Step 2. Evaluate opportunities carefully. Ask, what assets am I owning? How does it produce income? Who is managing it? What are the risks? Step 3. Think portfolio, not single asset. Build diversified exposure, multiple income streams, long-term resilience. 9. Key takeaways from Chapter 6. Insight: ownership is scalable, meaning not all or nothing. Fractional investing expands access. Wealth is not required. Strong assets matter more, meaning, than full control. Professional management reduces stress. Passive income grows. Education reduces risk, not avoidance. In one sentence, fractional ownership allows you to access high-quality, income-producing assets without needing massive capital or total control. Please be part of our success story that we will tell someday by subscribing, liking, and sharing the work of this channel. We want to grow with you from the beginning. Now let's continue to break down the book. Chapter 7: Diversify your investments for long-term success. This chapter reframes diversification from a buzzword into a survival strategy. True diversification is not about owning many investments, it's about reducing dependency on any single outcome. 1. The myth of traditional diversification. Mendenhall explains that many investors believe they are diversified because they own multiple stocks, mutual funds, index funds. But in reality, most are still tied to the same market forces. Correlations rise during downturns. Diversification collapses when it's needed most. Owning many things in the same system is not diversification. 2. What real diversification means. According to Mendenhall, real diversification involves different asset classes, different income drivers, different risk exposures. True diversification spreads risk, opportunity, cash flow across unrelated systems. 3. Diversification beyond Wall Street. The chapter emphasizes moving beyond stocks and bonds, market-based speculation, into real estate, private businesses, alternative assets, income-producing investments. This reduces exposure to market crashes, inflation, and systemic risk. 4. Cash flow is a diversifier. A powerful insight. Income-producing assets diversify lifestyle risk. Cash flow cushions volatility. Passive income reduces emotional decision-making. Cash flow is financial shock absorption. 5. Time-based diversification. Mendenhall also introduces diversification across short-term income assets, long-term growth assets. This allows stability now, growth later, without overexposure to any one timeline. 6. Why over-concentration is dangerous. Many people unknowingly concentrate income, one job, investments, one market, retirement, one account. This creates fragility, anxiety, limited options. Concentration increases risk faster than most people realize. 7. Diversification is about resilience. The goal isn't maximum returns, it's adaptability, endurance, optionality. Diversification ensures one failure doesn't collapse everything. Opportunity exists in multiple environments. 8. Practical application. How to apply this chapter. Step 1. Identify concentration risk. Ask, how many income sources do I have? How correlated are my investments? What happens if one fails? Step 2. Diversify intentionally. Focus on different asset types, different cash flow sources, different economic drivers. Step 3. Balance risk and control. Combine active income, passive income, growth assets. 8. Key takeaways from Chapter 7. Insight, meaning. Diversification not equal more assets, it's about independence. Wall Street assets correlate, especially during crises. Cash flow reduces volatility, emotional and financial. Concentration increases vulnerability, even if it feels safe. Resilience beats optimization. Long-term success. In one sentence, true diversification protects your future by spreading risk, income, and opportunity across systems that don't fail at the same time. Chapter 8. Leveraging Real Estate. This chapter dives into one of the most powerful tools for building wealth, real estate. Real estate isn't just about buying property, it's about using leverage, cash flow, and strategy to create financial freedom. 1. Why real estate matters. Mendenhall emphasizes, real estate produces cash flow, not just paper gains. It protects against inflation. It allows leverage to grow wealth faster. Ownership gives control and independence. Unlike stocks, real estate is tangible, manageable, and resilient. 2. Understanding leverage. Leverage means using other people's money, loans, partners, to acquire assets, controlling a larger asset with a smaller upfront investment. Example: buy a $300,000 rental with $60,000 down. Bank finances the rest. Rent pays the mortgage and produces extra cash flow. Leverage magnifies returns when used strategically. 3. The difference between good debt and bad debt. Mendenhall ties this to earlier chapters. Good debt, backed by income-producing assets. Bad debt, consumer loans, high-interest credit cards. Good debt in real estate. Financed properties, leveraged syndications, mortgages on cash-flowing assets. Using debt wisely creates growth. Using it recklessly creates vulnerability. 4. Cash flow over appreciation. A recurring principle. Focus first on monthly income from properties, then consider appreciation as a bonus. Cash flow ensures financial stability, reinvestment opportunities, reduced stress. Don't rely solely on market timing or rising property values. 5. Types of real estate investments. Mendenhall introduces several options: direct ownership of rental properties, traditional buy and hold; real estate syndications, fractional ownership with professional management; REITs, real estate investment trusts, for exposure with liquidity; commercial property, higher returns, higher expertise needed. The right choice depends on capital, risk tolerance, and personal goals. 6. Why real estate is a wealth accelerator. Real estate allows compounding through leverage, passive income from tenants, tax benefits, depreciation, deductions, long-term wealth creation. The combination of cash flow plus leverage plus appreciation is hard to replicate in other asset classes. 7. Common mistakes to avoid. Mendenhall warns against buying without understanding cash flow, over-leveraging without contingency, chasing appreciation only, ignoring market trends and tenant quality. Education and diligence are key to success. 8. Practical application. How to apply this chapter. Step 1. Assess your capital. How much can you allocate for down payments? What risk can you handle? Step 2. Choose a strategy. Direct rentals for control, syndications for hands-off income, REITs for liquidity. Step 3. Start small. Consider one property or one fractional investment. Learn systems, cash flow, and management. Step 4. Reinvest. Use cash flow and profits to acquire additional properties. 9. Key takeaways from Chapter 8. Insight. Real estate is tangible, not abstract like stocks. Leverage accelerates wealth. Use wisely, not recklessly. Cash flow greater than appreciation. Income creates stability. Good debt is a tool. Bad debt is a trap. Education reduces mistakes. Knowledge protects capital. In one sentence, leveraging real estate allows you to create passive income, magnify returns, and build long-term wealth while maintaining control over your financial future. Chapter 9. Not understanding your taxes could cost you your business. This chapter emphasizes a hidden threat to wealth creation: taxes. Mendenhall stresses that even successful businesses or investments can fail if you ignore tax strategy. Taxes aren't just an obligation, they're a tool. Mismanaging them can destroy financial freedom. 1. Taxes are a silent wealth killer. Mendenhall points out many entrepreneurs and investors underestimate taxes. Failing to plan can leave large portions of profit to the government. Over time, small mistakes compound into major losses. Ignoring taxes is like building a house without a foundation. It will collapse eventually. 2. Business income versus personal income. Key insight: income earned in a business can be taxed differently than personal salary. Treating all income the same leads to overpayment. Understanding business structure affects tax rates, deductions, and reinvestment opportunities. 3. Tax rules can help you keep more of what you earn. Mendenhall highlights strategies legal under U.S. tax law, also applicable broadly: deductible business expenses, depreciation on assets, retirement contributions through business entities, pass-through entities to reduce tax liability. Taxes are a tool to grow wealth, not just a burden. 4. Misunderstanding taxes leads to vulnerability. Common mistakes entrepreneurs make: failing to separate business and personal finances, not tracking deductible expenses, taking all profits as personal income, ignoring long-term tax implications of investments. Consequences: higher tax bills, reduced cash flow, potential audit exposure, slower growth. 5. Cash flow management and taxes. Mendenhall emphasizes that taxes affect real-world cash flow, not just bookkeeping. Overpaying reduces reinvestment capital. Underpaying can trigger penalties. Strategic planning ensures money stays in the business longer. Cash flow management is inseparable from tax strategy. 6. Practical application. How to apply this chapter. Step 1. Separate finances. Maintain distinct personal and business accounts. Track all income and expenses diligently. Step 2. Educate yourself. Understand the tax rules for your entity type. Know which deductions and credits apply. Step 3. Plan ahead. Anticipate quarterly payments. Reinvest profits strategically. Use depreciation, retirement contributions, and other legal methods. Step 4. Seek expert guidance. Certified accountants or tax advisors can save more than they cost. Regular reviews prevent surprises. 7. Key takeaways from Chapter 9. Insight. Taxes silently reduce wealth. Meaning, planning prevents losses. Business income differs from personal income. Meaning, structure matters. Ignorance is costly. Meaning, knowledge is power. Cash flow and taxes are linked. Meaning, strategy keeps money working. Expert guidance accelerates growth. Meaning, avoid DIY mistakes. In one sentence, understanding taxes and using them strategically protects your business, preserves cash flow, and ensures long-term financial growth. Chapter 10. Building your legacy and making a positive impact. This chapter shifts the focus from making money to making meaning. Mendenhall emphasizes that true wealth is measured not only by net worth, but by the impact you leave behind. Money is a tool. Legacy is how you choose to use it. 1. Redefining wealth beyond money. Mendenhall challenges the idea that wealth equals luxury, status, consumption. Instead, real wealth includes freedom, security, contribution, generational influence. Wealth without purpose eventually feels empty. 2. What legacy really means. Legacy is not only inheritance, assets passed down. It also includes values, habits, financial education, and mindset. What you teach and model can be more powerful than what you leave behind. 3. Building generational wealth intentionally. Mendenhall stresses intentionality. Wealth without planning disappears quickly. Many families lose wealth within 1 or 2 generations. Key components of generational wealth: financial literacy, diversified assets, tax efficiency, clear succession plans. Using investments to create positive impact. The chapter highlights impact investing, supporting businesses that improve communities, ethical real estate development, job creation through entrepreneurship. Profit and purpose do not have to compete. Teaching responsibility alongside wealth. One of the strongest points: giving money without teaching responsibility can harm future generations. Education creates stewardship. Ownership creates accountability. Mendenhall encourages involving family in financial discussions, teaching basics of investing early, modeling discipline and generosity. time, freedom, and presence as a legacy. Legacy isn't only financial. Time with family, freedom to choose meaningful work, presence during important moments. The life you live today becomes part of the legacy you leave behind. 7. Practical application. How to apply this chapter. Step 1. Define your legacy. Ask, what do I want to be remembered for? Who benefits from my success? What values matter most? Step 2. Align money with meaning. Invest in causes you believe in. Build businesses that solve real problems. Support education and opportunity. Step 3. Document and communicate. Estate planning, succession planning, open conversations with family. 8. Key takeaways from Chapter 10. Insight, meaning. Wealth is more than money. Purpose matters. Legacy is intentional. It doesn't happen by accident. Education outlives inheritance. Knowledge compounds. Impact and profit can align. Conscious investing. Time is the ultimate currency. Presence matters. In one sentence, true wealth is measured by the freedom you create, the values you pass on, and the positive impact your money enables. Chapter 11. Unlocking your financial potential. This final chapter brings everything together. Mendenhall makes it clear that financial success is not about luck, timing, or intelligence. It's about alignment, action, and belief. Your financial potential is already there. What's missing is removing the shackles holding it back. 1. The biggest limiter is belief. Mendenhall emphasizes, most people are not financially limited by opportunity. They are limited by mindset. Beliefs shape decisions, and decisions shape outcomes. Common limiting beliefs: I'm not good with money. Investing is too risky. Wealth is for other people. You cannot outperform the beliefs you live by. 2. Awareness creates choice. Once you understand how money works, how systems are designed, how risk is misrepresented, you gain clarity, confidence, and control. Financial awareness turns reaction into intention. 3. Education unlocks opportunity. A key theme: financial literacy multiplies opportunity. Ignorance amplifies risk. Education reduces fear. Mendenhall reinforces, learning precedes earning. Understanding precedes investing. The more you know, the less you rely on hope. 4. Action is the final key. Knowledge alone is not enough. Insight without action changes nothing. Small, consistent steps create momentum. Examples of aligned action: starting with fractional ownership, diversifying income streams, reallocating capital intentionally. Progress beats perfection. 5. Aligning strategy with purpose. True potential is unlocked when investments align with values. Money supports freedom, not stress. Growth serves life goals, not ego. Wealth should serve your life, not consume it. 6. Long-term thinking creates stability. Mendenhall encourages patience over speculation, systems over shortcuts, consistency over intensity. Long-term thinking allows compounding, resilience, and peace of mind. 7. Responsibility is empowerment. A powerful closing insight: blaming systems keeps you stuck. Taking responsibility gives you power. Responsibility means educating yourself, making informed decisions, adapting when conditions change. Ownership creates freedom. 8. Practical application. How to apply this final chapter. Step 1. Identify your shackles. Ask, what beliefs are limiting me? Where am I avoiding responsibility? What fears are driving my decisions? Step 2. Choose one action. Invest time in education. Diversify one income stream. Evaluate one alternative investment. Step 3. Commit to long-term growth. Avoid emotional decisions. Focus on systems, not shortcuts. Review and refine regularly. 9. Key takeaways from Chapter 11. Insight, meaning. Mindset shapes outcomes. Belief precedes action. Education reduces fear. Confidence creates knowledge. Action unlocks potential. Insight must be applied. Alignment creates peace. Wealth should serve life. Responsibility empowers. Control comes from ownership. In one sentence, your financial potential is unlocked when belief, education, action, and purpose align into a clear, intentional strategy. Please be part of our success story that we will tell someday by subscribing, liking, and sharing the work of this channel. We want to grow with you from the beginning. Thank you for watching and subscribing.